Hello and welcome to this week's instalment of Nucleus Investment Insights. We have another special guest this week in Aleks Vickovich, who is currently digital editor at the refreshed Sky News business channel, which is now called Your Money. In today's interview, we dive into Alex's take on the major outcomes of the Royal Commission, the impacts expected on both the incumbent advice majors and new licensees, and how the changing landscape of financial advice is to look in the near future. During his many years as managing editor of a number of leading financial publications, Aleks sits in the perfect position to provide some serious insight into a major component of the Australian economy. After the interview, we'll then look at some of the wider investment implications that these themes can impact on how we invest money every day at Nucleus Wealth. So join Nucleus Wealth's Head of Investments, Damien Klassen, and myself as we learn more about the real impacts that the banks are having on everyday Australians' lives and what looms in their future and the future of the Australian property market. I hope you enjoy. Today on the podcast, we have experienced news reporter, magazine editor, foreign correspondent, speechwriter, and author of the biographic book, USA G'day. Aleks Vickovich, welcome to Nucleus Investment Insights.
G'day, Tim. Thanks for having me.
So I might start with a question that I've posed to a few of our recent guests, and I'll just provide a bit of background. So we had around 18 months of debating in Parliament as to whether or not we should even have a Royal Commission. We've now had public hearings over 68 days, over 130 witnesses in the stand, and over 10,000 public submissions provided. We've had a number of banking elite heads that have rolled, and we've seen hospitalisations both physically and career-wise throughout the Commission. And now, of course, we've got a 1,000-page report telling us, in essence, that it's all the fault of the regulators and the mortgage brokers. So given your experience covering news for many years in the Australian financial services industry, is this the Royal Commission that you could have hoped for?
Well, I think you mentioned there the 18 months of debate, but I think probably, Tim, you can date it back to at least 5 years. We've been having this debate over what indeed we should do to fix the problems in the financial system. I certainly have been covering, calls for a Royal Commission for that long. Look, I think similar to what perhaps many of your listeners are feeling, I certainly felt a sense of disappointment at the final report itself. I was pretty public about that. I spoke about that on telly, on Your Money, and I wrote an opinion piece about that, which you can get at yourmoney.com.au/royal. And that's because of a few things. As you say there was firstly a lot of emphasis placed on mortgage brokers. Now, whatever you think around upfront commissions, and we can have a deeper chat about that if we want, as someone who was in the room for much of the inquiry and listened to pretty much all of the testimony, I really don't see the causal links between upfront mortgage broker commissions and the misconduct that we heard. Separately, it might be good public policy to do away with them, although I would argue, it probably isn't. But putting that to one side, I really don't think that solving this issue, goes to some of the deeper problems that we heard over the last 12 months. So that was the first thing, was this kind of knee-jerk response from the Royal Commissioner to go at intermediary remuneration, not, firstly on the mortgage brokers, but also financial advisors. The grandfather commissions are back on the table and they should be banned, enhanced disclosures and so on. So, we can get down into the guts of what it means for financial advisors and their clients. But overwhelmingly, I thought there was a disproportionate mention around intermediaries. It was literally the first recommendation of the 76. And I don't think that's reflective of what we'd heard over the last, 12 months or so. That was the first thing. The second thing that was disappointing was, again, kind of a lazy response from the Royal Commissioner on this idea that ASIC and the other corporate regulators should now go and implement these industry codes of practice. Now, these documents are okay as documents, but you look at who's come up with them. It's the Australian Banking Association, the Financial Services Council, and all of the organisations who were for several years trying to obfuscate this debate, stop a Royal Commission from happening, and said we shouldn't have one. And now the Royal Commissioner is recommending that we use their in-house ethical guidelines, that have been written by a bunch of lobbyists, as being some sort of panacea for the industry. So I think insofar as this recommendation in particular would help entrench the power of those lobbying organisations, I don't see how Ken Hayne could possibly think that's in the public interest, particularly since his inquiry, took aim at those organisations from time to time. So that was the second thing. And then the third thing, was I think the concern that probably the general public had, which was where are the heads on stakes. There wasn't any individual accountability in the report as such, despite the fact that, throughout the inquiry, individuals were named and shamed and put on the stand. And that was the whole point of this inquiry, was to try and get the individuals responsible to answer for themselves. Now, that's not to say that we won't see that. Obviously, the Royal Commissioner referred a number of matters to the very regulators that, of course, he also said were incompetent from time to time. We'll see what happens with those potential prosecutions. But overall, I think when it comes to the recommendations, I was certainly disappointed. And I think, we heard from the very first minute of the Royal Commission, Rowena Royal Counsel assisting said that they weren't just going to look at illegality, but also at any conduct that had fallen below community expectations. And frankly, I think the Royal Commission itself has been guilty of the same in the end.
Okay, yeah, sure. And look, you touched on there, and obviously, I think for anyone who was following through your last masthead at the IFA, it was riveting updates that I think a lot of the financial planning industry, myself included, it was pretty much a pay-per-view event. So I do thank you for that effort that you had in spending all that time there with yourself and your team.
Yeah.
You mentioned that. So I guess the question really revolved around, perhaps, was it diving into the cultural sort of side of the way that the banks operate as well, as opposed to just the raw legality or illegality?
Yeah, well, I think that was the point. But I think, there are a lot of upsides in this inquiry and what's come out of it, which I can get to. I think the problem is not with what the Royal Commission focused on. Frankly, I think they did a wonderful job of uncovering the misconduct and apportioning blame to a certain extent at the right sources. A number of senior business leaders fell on their swords over things that either they were directly responsible for or that occurred under their watch. And that we rarely saw happen before this inquiry. And also, of course, they brought to light a whole range of stories and case studies that, might have been whispered about in the industry but wasn't widely known, and certainly the consumer had no idea. So I think what they focused on was right. Where I think there's been a problem is simply in the recommendations. And, there may still be, he also says in his final report, there needs to be more widespread reform of the law. He doesn't recommend that, though, but he does say this is just a starting point. So, we may see this debate ongoing. What I think the problem was, though, was I think that the commissioner and the lawyers that are working with him are skilled at what they do. And the people listening will understand that. People have their various areas of expertise, and theirs is prosecutorial. They were excellent at cross-examination. They were forensic in their, analysis of the documents that the banks and the others were forced to put forward. And they did a really good job of bringing to light these issues. It's a very different skill to then take all of that information and make public policy recommendations. I mean, the Royal Commission is not a think tank. It's not a bunch of academics and policy experts. And I think, frankly, that's why what they ended up recommending was, not really visionary enough, to put it mildly. It seems to me as though they just said, well, what do we do now? And they looked at the findings of previous inquiries like the Sedgwick report and the Productivity Commission and Dyson Hayden's recommendations, and they just sort of cobbled together a report that recommends stuff that we've heard for years and years, like reforming mortgage broker remuneration and ending grandfathered commissions for financial planners. So, I think that was a breakdown in the process. So hopefully now others who are watching closely and our elected policymakers have a look at exactly what the misconduct was that occurred, and they reflect on it properly and they look beyond the recommendations. But I don't hold my breath on that, because of course the whole political discussion now heading into the election is around these 76 dot points and how many are going to be implemented.
And how.
Yeah.
And Alex,
right.
we had the view sort of coming out of this that there's certainly some short-term issues, which we'll sort of go into a little bit later, just over the whole housing prices and issues with the HEM and things like that sort of are forcing down credit. But I guess as a big picture view, the longer term look for the banks is still relatively bright in terms of, you could have looked at these things and they could have said, okay, we need structural separation, or we need, Dodd-Frank type laws, or whatever it is, to try and separate these various things and to lower returns that banks could make over the course of a cycle. But effectively, it does appear as if they're sort of, besides the short-term economic issues of lending growth sort of fading away, banks still have the license to go out and make as much money as they possibly can through as many different avenues as they possibly can.
Yeah, absolutely. And I think, look, for anyone who has been following financial regulation in the last few decades, and particularly since the GFC, it shouldn't be a surprise to anyone that we have now learnt that the banks are too big to fail. I think that probably would have been a foregone conclusion before this inquiry. And of course, in Australia, we have a banking guarantee. We have a 4 pillars policy, which treats those 4 particular organisations almost as protected species under the law. So we knew that it was probably going to end up in a position where the banks were still all powerful. But as you allude to there, they may have recommended some things that were a lot more systemic and a lot more than sort of, focusing on the low-hanging fruit of mortgage brokers and so on. For example, I mean, you could have, as you said, breaking up the banks would have been one potential solution, but even just reform of the licensing regime in general. Now, look, I've been covering this space for some time, and I was watching it unfold on telly like a lot of your listeners were. And to me, one of the things that continues to come up, particularly in that wealth management space, is the licensing system and the power that individual organisations have over other organisations when they authorise them under their licence. That is where a lot of the misconduct occurs, and also the product bias and just generally some of the business activity that has found to not be in the public interest. It often occurs by way of that weird relationship that we have in the corporations law. And there was no discussion at all from Kenneth Hayne in his final report around reforming the AFSL regime or overthrowing that regime. When it comes to financial advisors, he made an odd statement about needing them to register individually, but most of the lawyers that I've spoken to are not reading that as a recommendation towards fully fledged individual licensing or away from the system that we've got now. So not only, I think, are the banks in a pretty strong position following the inquiry, I also think that they were expecting to be hit harder when it comes to the, recommendations. And I do wonder whether, we've seen over the last 12 months, 3 of the major 4 organisations moving proactively to get out of the wealth management industry. We haven't heard a lot of updates on that front about when and in what shape these divestments might occur. And the answer that they've given is because of the Royal Commission. But when you factor in that it wasn't a recommendation to split these things off, that really, in some ways, the Royal Commission has recommended that the status quo continues when it comes to, the way that aligned advice networks operate. I wonder whether there's a few people in a boardroom saying, why did we make this announcement, and considering, about turning on the whole thing and just sticking to a profitable conflicted model.
Yeah, look, and I think you make a great point there, because certainly for mine, and obviously this is, from an industry perhaps insider sort of, point of view, I always suspected the aligned advice component of the Royal Commission was going to get a lot more airtime and a lot more attention, as I suspect perhaps a lot of people did. Maybe the big banks that were divesting at an alarming rate as well. And do you really feel it's almost like it's an omission from the whole thing, maybe just purely from the quantum of areas that the Commission covered? Do you think it was sort of given a back seat and perhaps even forgotten about, or something more sinister?
No, look, I think that it was covered pretty comprehensively. And you've got to also factor in that a number of other inquiries have looked at this. ASIC, while it was, it took a Senate inquiry to force them to do this, but they eventually launched their own, what they call the Wealth Management Project, where they look specifically at the 6 biggest advice providers and the quality of advice they're looking at. Productivity looked at vertical integration and has had a lot to say about that, the Productivity Commission. So, look, I don't think its remit was to deep dive on this particular issue, and it did raise plenty of problems within the aligned advice networks. I mean, Jack Regan's testimony around the buyer of last resort scheme at AMP, was a pretty, step-by-step analysis, if you go back and read it, of what is wrong with some of those big aligned networks, and how they are using all sorts of legal structures and this whole idea of risk management to really be a front for trying to push consumers into certain products and increase funds under management. So I do think that the Royal Commission dealt with that issue, but as you say, look, it didn't seek to pull it apart. Maybe they were being reactive to the moves that the institutions have already made, but I don't think so. In some ways, you could argue that at least one of the recommendations entrenches that power of the aligned and that model of the aligned network. In particular, one of the recommendations is that financial advisors who aren't independent, now this is going to get complicated, but basically under the Corporations Law, Section 923A, it sets out what a financial services provider needs to do in order to meet the legal definition of independence. If you don't meet that, which the vast majority of financial advisors don't, as you know, then Hayne recommends that you need to write to your clients explaining that and explaining why. Now, the banks are going to be very happy about that, because that means that all of these non-bank groups in the middle, all of these sort of groups, perhaps like yourselves, who are providing competition in the market, who have their own license, who determine their own destiny, but who, for all sorts of reasons, aren't legal independents, it makes it more difficult for them to differentiate their model versus the kind of service that you would get at a big 4 bank or a large financial institution. And I don't think it is the same sort of service. And yet again, we're seeing that the bank lobbying on this to try and reduce those, competitive advantages of the mid-tier non-institutional market. Again, that's working, and I think that's these lobbying organisations really working for their wage there.
So just sort of following on from that point, how do you think the Royal Commission has impacted the say the IFAs or the non-major advice providers in the this part of the world?
Well, look, I think it's sort of 2 steps forward, 1 step back for that movement in some ways. Leading into the Royal Commission, I was in a very good position to gauge in my previous role, the mood of the electorate in the IFA sector and financial advice industry. And, clearly they were split. The industry was very split on this Royal Commission. And a number of those in the independent space said, no, actually, it's a good idea because this is going to point blame where it needs to be pointed. And I think that, leading into this, and it wasn't just the Royal Commission, there's been a whole range of things that have led to the independent movement. The Commonwealth Bank inquiry before the Senate was a major catalyst. Productivity commissions and other inquiries. It's been really an escalating, snowballing issue. So there has been this movement towards independence, and the Royal Commission is part of that. And I think there was increasingly a sense of optimism heading into the Royal Commission. I wonder now whether some of those independents are, believing it to be a good outcome for them. Now, we should say the job of the Royal Commission was not to create more favourable business conditions for independent financial advisors. So I don't think the general public cares, frankly, one way or the other, whether that's helped them. Now, what the public does want is good quality service, and they should be entitled to that. And in my personal view, they're more likely to get that from somebody who makes their own decisions and is as best as possible free of conflicts. So, the growth of the independence movement and that as a purchasing option for consumers would be a positive thing. But I do think that some of that positivity will have died away. Because they will have read this final report and said, why is our grandfathered revenue front and centre when we've heard some really alarming misconduct that is higher up the chain than that, and that hasn't really been addressed from a policy point of view. For example, when I think about the last 12 months, what stands out to me is not grandfathered conflicted remuneration for financial advisors. What stands out to me is the evidence of AMP at the very senior level, CEO and general counsel, colluding with a blue chip law firm to lie to the regulators. And we may ultimately come to see those documents now, which I'm relishing. But that is the sort of cronyism and corruption in the system that is way more serious, in my assessment, than upfront commissions or the remuneration of small business people. And I think that most IFAs would agree with me on that. And I think they're disheartened that that's not where the conversation is right now. Having said that, regardless of their sentiment, regardless of how they feel about stuff, there are clearly more independent options in the market now than there were a few years ago. The banks themselves have thrown in the towel, even though they said that they would never get out of this market. And so, I think there are benefits to the consumer in having a more competitive market, and I think the Royal Commission can take some credit for that.
Yeah, okay. Yeah, sure.
Aleks, just moving on to onto what I alluded to earlier about the sort of short-term slowdown. I guess we have a view of the Australian economy that a lot of the housing prices was basically, whether you want to call it liar loans or however you want to define it, but basically when people can get 50% more. They can loan 50% more than what they should be able to loan because they can because they're using a measure that's far too low. The bank's using a measure that's far too low. That inflates your housing bubble for you and gives you gives you a run up in your housing prices. And so the removal of that then sort of means that is a big factor in house prices falling. The next take though was that I guess a lot of people were looking at the end of the Royal Commission to say, well, the banks have sort of tightened lending standards because this Royal Commission's on, and once we actually get the recommendations, then they can actually then start. They'll know where the line is drawn, and so then they can actually go back to lending a little bit more and help juice the economy again. Whereas, given there was sort of no recommendation around that, and more specifically though the Justice Haynes said that you need to wait for the outcome of a court case between Westpac and ASIC. That sort of, to me, puts the banks sitting on their hands for another 6 to 18 months while we wait for this next court case. So I guess there's not a lot of it's hard to find a bull case for the Australian housing market or a case that we're getting close to the bottom when we're not going to see credit availability sort of expand for at least another 6 to 18 months.
I think, as you say there, it's all eyes on that particular court case, as well as another court case between ASIC and Westpac on general advice, which will have a huge impact on the market as well. But, look, when it comes to these sort of monetary policy discussions and how they impact housing, you do have to feel for the central bankers in to some regard. I mean, if you have a look at our previous model and certainly what they had in the United States in the lead up to the financial crisis, you've got a government policy that is encouraging home ownership. And arguably that leading to a lot of the problems in over availability of credit, and then all the securitization that went on the back of that. So they tighten these things up in response to all the doom and gloom that the economists are putting out there, and they can often go too far, and perhaps we're seeing that now. What I find really interesting is in the last few days, even the banks are launching new marketing campaigns, and they've been pretty quiet on that front while the Royal Commission's been going on. It's been very general, we support Australia type branding ads. But in the last few days, they've been pushing, and we did a segment on this on Your Money Live last night, where they're really starting to, unleash the gimmicks once again. They're talking about, getting frequent flyer points with your home loan. So you have to wonder whether that indicates that it's not just this whole regulatory issue that is impacting this credit conversation and the banks being tight on credit. Is there a consumer confidence issue that's playing in here as well? Because if they're marketing people to take out home loans, that indicates to some extent the consumers thereafter, at least, may have some hesitancy as a result of all this change.
And I think you sort of hit the nail on the head there. Like, obviously the banks are potentially dipping their toes back into the water vis-a-vis home loans, perhaps trying to get ahead of the undoing or the winding back or the watering down, perhaps, of the broker influence. But look, for mine, it's always been interesting because I don't think a broker does anything wrong. They go out there and find opportunities that you can't get in the major banks, or at least you can. They give you access to second tier, or whatever you want to call it, opportunities that don't have retail bank branches. And in effect, I think vis-a-vis, that's sort of what a broker is in a way. The key thing there, I think you said it a little bit earlier though, was that by removing that, you're putting a lot of power back into the banks. But at the end of the day, isn't it the lender that's responsible for approving the level of debt, not the brokers per se? Now, the broker might be able to do some things around the edges, and this is where I think Hayne was trying to address by going to a fixed fee model as opposed to percentage based and these sort of things. But what are your thoughts on where the broker's responsibility stops and the lender's responsibility begins when it comes to things like people overextending themselves with credit?
Yeah, I totally agree with you. I mean, I think mortgage brokers provide an important service in the market, and I think most people who are serious about competition and good consumer outcomes in the financial system, would understand that important role that they play. Similarly, I don't think that there was a problem with investment commissions necessarily in the financial advice space prior to the FOFA reforms. And having watched that ban on commissions play out, that's one of the things that makes me, as an objective observer, I don't have any commissions, and that's not how I'm remunerated anyway. As a third party, fourth estate, watching this, that experience makes me nervous about this recommendation as well. What I think sometimes gets conflated is, people look at remuneration as being conflicted when really what we have is an honesty problem. And I think that is potentially true both of financial advisors prior to FOFA and also mortgage brokers now, where the way that they're paid is not necessarily the problem. The way that they describe themselves to consumers is a problem. And, advisors who, for example, were tied to certain products, perhaps were not, disclosing that properly. There were all sorts of sub-brands and subsidiaries. And, I think if you went down the local street and asked people, does Westpac own St. George and does the Commonwealth Bank own Bankwest, people still don't know these things, and it's imperative that they know. I think those sorts of issues were more of a problem. So I think that, a culture of honesty would have been a better solution. Now, of course, that's easier said than done, and it's difficult to legislate for. But I think that mortgage brokers, for example, provide a great service. Having said that, I do think there are issues when, brokerages are owned by lenders under, very famous, independent sounding brands, and they're subject to all the same sort of vertical integration and product bias issues when it comes to their loan recommendations, as financial advisors are. I also think that, so lenders play...
Sorry, Alex, just on that one to cut in. So do you think, though, that's that's sort of an ACCC, that's a competition issue that should have been done years ago, in terms of saying, well, if you're 25% of the loan market, then you shouldn't be allowed to buy the brokers, right? And so now it's a matter of trying to clean that up, as opposed to, having never let it happen in the first place?
Yeah, look, I think so, but it's not so much a problem that it is happening. The problem occurs in the amount of literacy that the consumer has in what is going on here. It's the visibility, it's the transparency around the ownership, and it's this false pretense of independence that's the problem. So I'm not really sure that is an ACCC issue, because it's not my contention that these sorts of mergers and acquisitions should not be allowed to take place. It's just that when they do take place, they shouldn't be able to pay John Simon as an actor, for example, and have a brand that is totally independent of the bank, with a small disclosure or in the footer of their website that explains the fact that they are actually owned by the very people that in their TV advertising they claim to be providing competition against. So, I think that there is an issue there. And I think the other person that needs to take responsibility, of course, is the individual that is, the borrower. And I think that is the real upside to me of this whole Royal Commission process. I think that we are seeing consumers look under the hood of the financial system in a way that they never have before. I think that they are more awake to these issues, even if we can't rely on the Royal Commission or our elected representatives to put in place good policy around it. I think that people are really starting to become more educated about this. And frankly, the launch of our channel is really a symptom in some ways of that. I mean, Your Money is owned by Channel 9 and News Corp Australia in a joint venture, which is interesting in itself, but we don't have time to get into all the politics there. But to have two of the largest media organisations in the country see that there is an appetite for and a need for a full-time, business channel that's devoted to these topics that we're discussing, among others, I think is really encouraging. And I think that really the Royal Commission has been a cultural shift in consumer land that is really positive, because, topics like vertical integration that once were spoken about quietly at industry conferences, whispered, over glasses of wine, are now spoken about on the ABC and on Channel 9 during mainstream segments. And, we use these sorts of terms on our website and consumers are understanding them. And that is because of, the Royal Commission essentially putting these issues on the agenda and taking them from the boardroom where they were hidden from public view and taking them directly to people's living rooms, which I think is, an enormous public good that's come out of this process.
Absolutely. And I guess really on that, so obviously, as we touched on quite a few times through the course of this chat, that the Royal Commission was quite good, I think, at the shock and awe public sort of side of things, as we saw fantastic viewing, just wonderful intercourse, I think, between big companies and regulators and obviously and the Commissioner and his team. Do you get the feeling that this may be sort of something of a more common occurrence going forward? Now people know that there is this sort of, I don't want to say whistleblower, but there's this opportunity for whenever an industry feels like it's going to getting a little bit ahead of itself to, for politicians, for example, knowing the impact that and the time it's taken, and particularly for Labor, and obviously this resounding win they've had in calling, and fighting for a Royal Commission. Do you think this is a lever that might be pulled more often going forward?
Look, without doubt, and primarily because those politicians who voted against this, time and time again, have got a lot of egg on their face, and this is an election issue now, and that's how much, that's how important it is. Not just the politicians, but there were a number of media commentators, out there who understand these issues. I'm glad to say that I wasn't one of them, but there were a number who said that we don't need a Royal Commission, including the Financial Review's editorial page. And they had to come out and essentially issue a mea culpa after the first day of testimony, saying we got this wrong. So I think that now there is an understanding, and we have had, of course, other Royal Commissions before this in a quick succession that, have cut through, particularly the Royal Commission into institutional child sex abuse, and others. I do think that this is going to keep happening. And look, on the one hand, I think that you can. It's very difficult to mount an argument that these sorts of inquiries are not in the public interest. When you consider that it's a whole bunch of stuff that's coming to light that is very easy to access. I mean, these are not, courtrooms where, everything is hidden and subject to suppression orders. This is live television that anybody can access, and that is in reasonably simple to understand language, and on individual case studies that are brought to light. So it's a format as well that is very powerful, and that I think consumers have clearly engaged with. So we are going to see it more and more every time there's an issue. I think politicians are going to be increasingly hesitant to put their votes against it. I think all of that is positive. On the flip side, $76 million of taxpayer money went to paying a bunch of lawyers for this inquiry. And, as much as I have listed a whole range of positives that have come out of it, I think it's for the public to decide whether it was ultimately a good spend of their money. And I think history tells us that these things are cyclical. And, I'd be very, very surprised if we had seen the end of misconduct in financial services. Indeed, ASIC put out a report just yesterday saying that the Big Four are all talk and no action on fees for no service so far and the remediation of that issue. So, look, on the one hand, I support anything that is good for transparency and that allows consumers to get access to this information. But I think there is a cost flow and effect as well, and you've got to make sure that we're not using taxpayer money just to prop up the games of the rich and powerful, and the media and politicians.
Yep, sure. Just one last one, actually. So you touched on, I think, an important, inevitability, really, of financial services, and no doubt many others, which is that it does, by and large, operate in a quite a cyclical manner. I think you hit the nail on the head there, and obviously, the cycle's now changed. So, the question sort of really relates to the fact that where do you see? Look, obviously, given the fact that the banks have just unwound some pretty massive sales and distribution components of their business, right? Yeah. So you'd probably say we're probably at the low end of that cycle. But where do you sort of see, given your experience in financial advice, over the last decade or so, the financial advice industry heading in terms of that sort of makeup of independence and how that's going to interrelate with the larger product providers, etc.?
Look, it's fascinating. I think obviously the trend at the moment is towards independence, whatever you kind of believe that to mean. Whether you see a whole bunch of consumers taking up legal independence that I referenced earlier, we'll have to wait and see. It requires quite a specific business model that may not be lucrative and that doesn't work in with some client bases and so on. So we'll see. I think we're going to see that trend continuing. I think it's probably likely that there will be some policy change at some stage that aids that, whether you get an individual licensing type model, the way that lawyers have with the Law Society, the way that individuals have in the United States via their regulators there, the SEC. So I think that will aid that. But of course, there's always big things going on. And the reason that this stuff is cyclical is because a lot of the people who actually control the shape of the financial sector, they continue to operate the way they always have. The first one is, of course, these lobbyists. Now, we touched on these briefly before, and I would include all of your trade associations in this bucket as well. Their job, of course, is to come out and to argue for policy outcomes that are in their members' interests. At least that has always traditionally been their business model. They now try and say that they also act in the public interest, which, as the Royal Commission pointed out, it's difficult for them to reconcile that. But the lobbyists, of course, will continue because they've got a guaranteed source of income by way of professional education. The more we make that sort of stuff compulsory, the more that these organisations, trade unions on one hand and business representative trade associations on the other, the more powerful they are and the more that they are a structural part of the market. And you can't understate the influence that these groups have in terms of, negotiating what the final law actually looks like. I mean, if you look at some of the laws that are pushed through in the financial space, I guarantee you that a lot of the specific wording has been written by people who work for these organisations, and of course the political staffers that they're close to who work for politicians. So that's one thing, and that is ongoing. And just briefly on mortgage brokers, I mean, there has been one of the most successful lobbying campaigns that we have ever, kind of seen in recent years in regards to this final report.
Yeah, they've certainly come out in force, haven't they? To great effect.
They've come out in force. They've enlisted high-profile members of their community like Mark Boris and others. They got the government, they got a Prime Minister to weigh in on their campaign, and they even got the Labor Party to back down on this issue in a matter of weeks. I mean, it's an unprecedented win in the lobbying world, particularly because in the last few years, some of these organisations, particularly those representing smaller businesses like the broking associations, they've been sidelined to some extent. And so this has been a big win for them. And I think other organisations are looking at the success that they've had, and they're feeling emboldened by this, and they're going to go out and try and run similar campaigns. And of course, we're already starting to see that. The other one, of course, is the big law firms. And this is something that the Royal Commission only touched on briefly. Now, arguably going into the Royal Commission, one of the main arguments was that, the boardroom and the CEOs and that level have not been held accountable enough. And I would agree with that. The Royal Commission went some way to starting to put these individuals, hold them to account. A criticism you could make of the inquiry was that too often there were middle managers put on the stand, or people who weren't there at the time. Rarely did you see the CEO, the chair, or the general counsel, who are probably the people who are best qualified to answer these questions. But having said that, it did go some way to holding senior leaders in organisations to account from a governance point of view. It touched the surface of this law firm issue, which is, big, fancy, expensive law firms advising big banks on the way that they should conduct themselves when they're dealing with the regulator, for example. And Clayton Utz and AMP is one example that we're seeing, and I would advise all of your listeners to keep watch on this, because this is a crucial part of how the sausage gets made. And I think that this was not really within the remit of the Royal Commission to look at law firms specifically, but I think that just this one issue being exposed where they were, there was this email chain where they were talking about, doctoring a report that was meant to be put up to the regulator. It's serious stuff. I think that, despite that, those law firms, their position and their strength in the market is, of course, upheld. And so they will continue doing that. And the final group, who didn't get a mention at all during the Royal Commission and rarely does, and is probably the most powerful of the three, are the management consultants, the McKinsey & Co. and so on, who are paid a lot of money to advise business on the sorts of decisions like, should you go and buy those licensees? Should you enter the wealth management market and set up these so-called financial supermarkets? If you trace back the trail of money, a lot of that thinking by, David Murray when he was CBA CEO, and these large organisations when they went and bought MLC and AMP merged with AXA, and they did all that, back in the day. A lot of that advice came from the people consulting them, who, of course, aren't actually making the decisions but are whispering in their ears. And these organisations don't get held to account on this stuff. And they will continue to be powerful, and they'll continue to have something to say when big businesses pay them a lot of money to come in and do a presentation. So this is why these things are cyclical. We're seeing the banks divest at the moment, but I do think that, I won't be surprised in 10 or 15 years when they are advised to go buy these businesses once again.
Yeah, look, and I suspect it might happen a lot sooner than 10 to 15 years, depending on what the shareholders are paying for blood and when they're going to be, obviously driving revenue streams from as well. So, look, mate, well, that's just about us pretty much out of time.
Actually,
one more from Damien.
Yeah, I've got a few questions, completely changing tack. Because I'm trying to sort of get off the Royal Commission onto sort of more broader investment themes.
Sure.
So Aussie investors generally are very underinvested internationally. And so I just wanted to sort of coming back to, I guess, our views on that whole part about the housing market slowdown providing sort of a pretty good opportunity for people to look for exposure offshore. I just want to see your thoughts in terms of whether you're seeing sort of at the coalface people are actually starting to get into more direct international investment, or are we still just seeing sort of more of the managed funds?
Yeah, look, I think that obviously this runs deep as a culture. I mean, firstly, our love of bricks and mortar, and then secondly, our sort of home bias towards Aussie equities. Very
to franking credits there. Our love of the tax.
Absolutely. So, this is an election issue as well now. I mean, if you told me, 4 years ago that there'd be an election fought on franking credits and the outcomes of, vertical integration in wealth management, I would have been surprised about that. But we'll see how that one plays out. And obviously that will impact the way that investors see these things. Look, I think there's two buckets. There are people who are already investing, who have these kind of, who come into this with a preconceived investment philosophy. And I think that's totally legitimate for people to have that when they're investing their money. Obviously, it's a task for those that advise them to try and tell them to look abroad if they think that's in their interests, and to educate them on this stuff. Certainly, we in the media try to as well. But I think where the real opportunity lies is in this large cohort of individuals who are waking up to the need to take control of their finances. And I do believe that there is a large group out there who are fit this bill. As I said earlier, they're watching the media, they're watching these issues play out, and they're starting to lean into this. And I think for those people who sadly don't have a lot of financial literacy in school and are coming with investable assets, but really very little in the way of knowledge or preconceptions to the investment world, I think there's a huge opportunity for the industry to start at square one with these individuals and families, and to explain to them, I guess, some of these broader issues you're talking about, and try to avoid some of the biases that perhaps, rusted on day traders invariably have. Yeah, look, I think that, that's a really interesting one, the international thing. The other one, of course, is this move towards passive. And I think that, the passive investment managers have done a great job in their marketing, particularly in the United States over the last 20 years or so, on capitalizing on fear and distrust that's really warranted, I guess, in the financial system. But they've done a great job of explaining to investors that passive is the solution to that. And I think that active managers, in my assessment, have done a poor job of responding to that. They continue to just talk about returns when they're not really engaging in that battle of ideas over, can people really outperform the market? Is that the burden of expectation that we should have from our financial product providers and our, those managing our assets? So again, I think on this issue, there is an opportunity for for active managers not just to talk to the people who perhaps have already attained wealth and have firm political views on these sorts of topics, but to engage the people that are coming into this relatively blind, although eager to change their situation.
Yeah, and I guess the issue from my perspective is, as an active manager, we sort of look and go, look, we think we can outperform, and we go through all our processes, and so far we've proven that to be true. The issue is, do I want to stand up for all the other active managers out there who I sometimes read stuff, I see in the paper and go, that guy's got no idea, and there's other ones who you go, yeah, these people do know what they're doing, but it's a lot harder as an active manager to stand up for your entire industry when you know there's people out there overcharging and taking far more than what they get. Whereas as a passive guy, if you're looking at, you're all investing in indexes and you're all charging quite low fees, it's a lot easier to stand up for people who are doing similar stuff to you, because there's not a lot of differentiation.
Yeah, that's really interesting. And I think that's probably one of the things that does lead to that hesitancy to sort of make the argument for active as a concept, rather than talking about the specifics of your particular philosophy and process. You hear a lot more about individual processes, but while I understand that from a marketing point of view, I think that it is legitimate for consumers to be questioning the fees that are being charged, and I think that passive is, for me, as someone who has been in an enviable position where I'm paid to learn about these things and understand them. I know that, a mixture of both of these kinds of products and diversification is the answer, and that in most cases, it's not in the interest of an investor to simply go for one style of investment. But, when I was on the ground in the US, I would meet a lot of investors and even investment advisors who would tell me that they are 100% passive. They are, paid up. They've been drinking the Kool-Aid. They don't believe that active can exist. They fully subscribe to this Vanguard mentality. And, I think that's a trend that's coming here. So however they go about it is up to them. But I think that the rest of the industry will need to come up with a plan to combat that. And I think now's a good time because, as I say, people are hungry for this information.
Very good. Okay. Well, yeah, thanks very much for that, Alex. And just while we've got our listeners on the line, how can they hear and read more about some of the work that you're doing?
Yeah, so yourmoney.com.au is the easiest place. So look, we didn't go into this believing it was going to be an easy task. A lot of media providers in the past have attempted to engage Australia with their finances, but we firmly believe that there's never better time than now, and we believe that if anyone's going to have a good crack at it, then we can. So you can find plenty of information there. And if I can put in a shameless plug, finally, Tim did mention at the outset there my book, USA G'day. I would say that it is semi-autobiographical, but thankfully for the readers, it's not entirely autobiographical. I talk about a whole range of issues there from my time covering the wealth management industry and also the US presidential election. So my publisher will be very angry at me if I didn't make that clarification, and they can find it on Amazon.
Yeah, sure thing, mate. I'll include a link in our show notes and on our YouTube page. So
appreciate that.
Look, on that note, thank you very much for your time today, and certainly we've got a lot out of it. It's great to hear somebody who's had such a breadth of experience and lived and physically breathed the air of a Royal Commission as well to give us some of your highlights and your insights. So we thank you for your time and look forward to getting you on very soon, Alex.
Yeah, thanks, gents, and commend you on the podcast. Great initiative, and keep up the thought leadership.
All the best. Cheers.
Good on you. Thank you.
So, Damien, terrific 50-odd minutes there spent with Aleks Vickovich, a guy that knows plenty about the Royal Commission. He sat through a lot of it and was feeding a lot of information back to the industry as eyes and ears, so that was always good to hear about. What were your sort of takeaways?
Yeah, look, pretty similar to what we've seen from a couple of our guests recently. I think that we've obviously focused a lot on this Royal Commission because banks and insurers are such a huge part of the Australian economy. They're sort of, the Australian stock market as well as the economy, sort of 40-odd%. And so, a real key issue for most people as you're investing is to say, has something structurally changed with the banks? So taking a longer term view about this, banks have managed to grow their loan books well above wage growth, well above inflation, well above, out of all these different practices, they've had double digit loan growth for years and years and years. And the question is saying, well, if people's wages are growing at 2%, you can't be growing your debts. They can't be growing their debts at 10, 15% every year. So that's got to come to a stop at some point.
Sure.
And so I think we haven't seen anything that's dissuading us from the view that in the short term that's finished, and that you've got you do have this payback now where people could borrow $1 million who can now only borrow $600,000 or whatever it is. So you've got this short term issue around investment, but there's going to be a time to buy the banks again, because what could have happened, as we spoke with Aleks, is you could have seen structural separation, you could have seen the banks being broken up, you could have seen rules about what they're allowed to do and not allowed to do. In the US, they have what's called Dodd-Frank, which sort of tries to separate what you can do in some banking and can't do in other ones. Okay. We've just tossed all that aside. We've basically said, well, the regulators didn't do as much as they could have done, and we'll ban some mortgage brokers, and by and large, the rest of it will sort itself out. And so what that does do is, once the sort of memory of this fades, and whether it be 4, 5, 6 years or whatever, to sort of move away from that, there's going to be a great investment case for jumping on the banks. We just think the cycle's turned on them though, and that you've got this short-term issue, and that step aside until it's time to come back once the dust is cleared. And
do you think that at least 3 of the 4 major banks jettisoning their advice sort of arms during the Royal Commission, it obviously means, in a sense, perhaps from a business point of view, that you can sort of cut off and remunerate and fix up and then start with a fresh slate for a potential, re-emergence into the advice industry at some point?
Yeah, look, I think if you took a 15, 20 year look at banks, they're pretty they're cyclical buyers and sellers of other add-on businesses as well. So they'll add a whole bunch of things to it, and then they'll get rid of them all, and then the next cycle will happen, and they'll be looking at all these other wealth managers or whatever they are, all these other aspects of the finance industry they can buy and bolt on, and then they'll be flicking them off again. So I've got no doubt that absent regulation that actually specifically prohibits them from doing things in different areas, you'll get a new CEO, and in 5, 10 years, 15 years time, whatever it takes for it all to start.
He'll have a bright idea. Hey, let's get back into the advice industry.
Absolutely.
And off we go.
Yeah.
Okay, very good. And just broadly speaking, around the housing market, obviously we've released recently an option as one of our portfolio screens to limit the amount of Aussie housing exposure, as we touched on last week's podcast. Yeah, so we within our portfolios, given the view we've got, we obviously limit the housing exposure as it in terms of what we actually buy within our portfolios. Sure. Having said that, though, I think as any sort of diligent manager would do, you have constraints around what you can and can't buy within portfolios, and so it's not a matter of saying, well, if you go with a manager that they can stick 100% into one speculative stock or whatever. So our limits are very much the top stocks. So within Australia, it's about the top 70. It's called the MSCI Australia Index. Yep. And within that, we've got plus or minus 15% to any one sector. If you go through the sectors, some of the very big sectors of the banks, we've got exposure to. Yep. And then within some of the other sectors, from time to time we've had exposures to other stocks. So what we've done is we've given people the option now to say, well, you've got these safety exposures on there so that you don't go too far away from your mandate, and you are providing a low risk, steady portfolio that's going to sort of outperform over time. Yep. But it's not taking wild bets. But we've got a lot of people who have said, no, I'd actually like to completely divorce myself from either the banks or anything to do with the property sector, whether it be discretionary retailers like Harvey Norman or anything like that. So in a sense, without having that ticked on, there's still some exposure in there just purely because the mandates we've put together, we could be very underweight them, or as underweight as we can go, but there's still the mandate requires us to have some in there, and therefore ticking the box means no, I'd like to reduce that to zero and effectively turn it on later on. And similar to what we do with a lot of things, where some people have chosen not to be in animal
health.
Yep.
Oh, sorry, anything
Animal
to do with
testing.
animal testing.
Yep.
And so, for a stock like a Unilever or something like that, used to be outside the index. It's now, come along and we've popped it back into those people portfolios. So we've got a number of those types of ones where people can make those decisions. The key thing I'd just say with the housing one is there will be a time to buy these, and that's where what we're trying to do is time these things. And when we say when the prices get low enough, we'll say, well, might not be the bottom, but we're happy to buy it at a certain level where we think we'll make money over the longer term. And so by switching them off, that's taking that out of our hands and putting it back into investors' hands, which is a good thing in some ways, but at some stage you'll need to reverse that.
Well, that's right. Yeah, I guess you could be right. You could be very right with it switched on, but you need to make sure that you untick it at some point so that you can replenish the portfolio. Okay, great point. All right, very good. So on that note, well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers. Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation.